Hey guys, today we're going to talk about fair value gaps, what they are, how to identify them, how to trade them, and some common mistakes that people make with fair value gaps. This is fairly introductory content. We'll get into more detail in future videos, but this is really to get you to grips with identifying and using fair value gaps to place higher probability trades. So we're just going to start with what a fair value gap actually is. Essentially, it's a gap between candle 1's high and low and candle 3's high and low, where candle 2 is creating that gap. So in this visual example here, I can make this a bit bigger just to make it really clear. This isn't the best drawing, but you can see we have candle 1 here, which is a bullish candle up. Then we have candle 2, which moves more aggressively in a bullish direction. And then we have candle 3, which continues higher. What it does is leaves a gap between the wicks of candle 1 and candle 2. So that's essentially what a fair value gap is. It's a gap between two wicks, candle 1 and candle 2. Fair value gaps show an imbalance in price action due to aggressive price moves, representing unfilled liquidity on your chart. So what does this mean? Forget the actual candles here. We are seeing bullish demand in the market. We get a retracement and further bullish demand in the market, and then further bullish demand in the market. So there's no retracement here into this area. If you're looking to get involved in longs here and you're waiting for price to retrace to go higher, you're just not getting entered into your position because there's too many actors in the market that are driving price higher. So what happens is that these imbalances in price get left and the market tends to gravitate back to them before either continuing further in the same direction or disrespecting them and targeting opposing lows. So that's what a fair value gap is. Why do they form? If it's not already obvious, it's basically aggressive price action. So price moving aggressively. And as I say, because of that aggression in the market, eventually the aggression or sell pressure will not sustain, and so they then act as liquidity points that price can return to before fair value is then offered in the market again, and that's why they're called a fair value gap. And new actors will step in, or the same actors will step in to drive price higher. So that's essentially what a fair value gap is. In isolation, that's all they really mean. But they can show you at key points of liquidity and key areas of resistance and support exactly what the market intends to do next. So first and foremost, how do we identify fair value gaps? So we're on Bitcoin actually today. And I'm just going to use the 2-day chart, why not, to see what fair value gaps are created and when they are and are not respected. So let's just draw these on quickly. So you have candle 1, candle 3. Here is a bearish fair value gap right there. It's an imbalance in price caused by this big sell-off candle. Then price returns, this being the magnet back, new price leg created with a new fair value gap right here. What happens now? So price trades into the fair value gap, goes higher. So it actually initially gets disrespected before a new price leg lower, new bearish fair value gap. This time it does get respected, price sells off. Then we get a leg higher, and then eventually bullish pressure steps into the market, at which point fair value gaps are created. So aggressive price moves without the opportunity for new actors to get involved. So it's leaving behind potential people that want to get involved in this move. New fair value gap again. Price trades in. This time actually just tags the fair value gap and goes higher. And then eventually new bearish fair value gap. This gets disrespected. We get a new bullish fair value gap right here. And like you see, it can get a bit messy if you're just looking at fair value gaps. But eventually, price disrespects this bearish fair value gap. So you can see if I just take away the bullish fair value gap, you get an imbalance between candle 1, candle 2, trades in, trades lower, trades back, new bullish fair value gap right here. And it gets disrespected and price goes higher. So you can see fair value gaps are painting almost like the story in the market of bearish price action, bullish price action, consolidation, bullish price action. So in terms of identifying fair value gaps, it's simply looking for candle 1 and candle 3 with the expansion candle in the middle and marking the imbalance between the two candles. So very, very foundational content here, but that is how to draw a fair value gap. Trading fair value gaps is something very different. This is where you need to then start to bring in a wider trading strategy. You need to always look at higher time frame context and always look for confirmation in your trades. But fair value gaps, like I've explained in other videos, are one point of internal range liquidity that you can trade from and take trades, you can place trades from. Now I'm going to just show you where this gets interesting. So here we are now just navigating down onto the 12-hour chart. So without drawing on any market structure, any order blocks, any liquidity, I'm just going to bring up some higher time frame candles. But actually, before I do, which is essentially trading candle ranges, because this is going to make the next example feel and make a lot more sense. So if we have here 3 candles, candle 1, candle 2, candle 3. Actually, I'm just going to bring this down slightly. Okay, so a lot of what I teach and the methodology that I follow is around trading candle ranges. So here you have it doesn't really matter if this is a bullish or bearish candle, but it's your first candle, candle 1. And this is where we see accumulation in the market. So treat that as accumulation. Candle 2 now has 2 options. It can either trade above its range and close, and then like that, and in which case we can see that buyers are driving price beyond this candle range. There's demand above this high. Or it can do this. It can trade above, and actually buyers don't sustain, demand does not sustain, sell pressure comes into the market, and candle 2 closes inside candle 1's range, which is high and the actual close of the candle. So as long as it closes within the entire range below the wick. If this happens, then there's reason to believe that there is enough sell pressure here, or a lack of buy pressure, demand in the market, to give you the belief that we need to seek liquidity lower. We need to seek, or price needs to find a new area of demand in the market before we either continue lower because there isn't any, or we then continue higher. And what tends to happen is this is where the liquidity points exist, and they tend to be at either the highs, lows of the close of the body of the candle, or at the candle's low. So let's just assume this is the candle's low. So as soon as we get a close inside this candle, there's reason to believe that we are going to expand to the base of candle 1. So that quick aside, this is going to give you more context into what actually happened with Bitcoin right here. So let's just bring on both the monthly candle and the weekly candle, and then let's get back to fair value gaps. So what happened here is price is expanding towards this high, making an all-time high up in the 120k plus for Bitcoin, liquidates the top of this candle, and let's forget for a second about where this closed, because actually it liquidated this candle and this candle before selling off. and actually just look at the weekly candle. So we know at this point here that we're liquidating a very key point of liquidity for Bitcoin, all-time high. Just remove that now. What we see is that we're also liquidating a high, a weekly high. So this is just a weekly candle. So firstly, we're looking at the entire range of price action for a month. Now we're just looking at the last week. So with that in mind, let's take a look at what actually happens from a fair value gap perspective right here. So fair value gaps are being created on this 12-hour time frame. Whether they get traded into or not, they are being created. So you have price leg, new price leg, new fair value gaps getting created. So 1, 2, there they are. There's the last fair value gap created. And then we get another fair value gap created. This time this gets traded into. So you see price, if I zoom in even closer right here, price retraces into this fair value gap and expands. We then get another fair value gap right here, which price trades into. But what is happening right now? We are trading into, we just zoom back out, this key level, and we're also trading into the previous week's high. So what we get then is a shift whereby we have bullish or fair value gaps being respected, and then a creation of a bearish fair value gap right there. So when we're expanding towards this high, as soon as we see that bullish fair value gaps are being respected, we can target this high and we can feel fairly confident that fair value gaps are going to be respected right here. So irrespective of the types of trades that you want to take, you can start buying these fair value gaps if you wanted to. There's a quick trade there. But then as soon as we see key points of liquidity taken, then reversals whereby new bearish fair value gaps are created, we're now looking at shorts because we are combining the creation of fair value gaps in context with higher time frame candles. And what we see then is that as soon as we get this shift, we can potentially get into the market to target this low. And that would be a very aggressive trade, we could say, because we haven't seen a close of candle 2. But the logic remains that we had price action in to a high, price action out of a high, bearish fair value gap created, and so you can take a trade from that level. Now, I'm going to show you just another example of this using the 2-week time frame. So if I just take this away, what we can see here is the exact same thing happening. And we can use fair value gaps again to think about trade ideas. Because what happens, we see bearish price action right here, whereby bearish fair value gaps are being created. So the last fair value gap is created right here. And what we see is that price comes up. There's no fair value gaps in this leg, creates a new price leg lower with fair value gap. Price trades into the fair value gap, tries to go lower. At that point, liquidates the previous 2-week candle. So this candle here. So price trades in, we then get a shift. No bullish fair value gaps are created as yet. But then what happens? We get the formation of a bullish fair value gap right here. So this is indicating to me that there is aggressive demand in the market, that buyers are in control of this market because we've disrespected bearish fair value gaps. We're now respecting bullish fair value gaps. So you can then place a long here, cover some of this liquidity here, maybe this low here, and then target the high of the candle that has been liquidated, this entire candle range. And there you have a 2.93R. And if you see what actually happens here, we just get respect of bullish fair value gaps. So another one is created right there. Price trades in, trades away. another bullish fair value gap created right here. Price trades in, trades away. We get a little bit of consolidation, but we continue higher. Price creates another fair value gap higher. Price trades in, trades away until we liquidate this candle. And then what happens? New fair value gap lower. So then there's short opportunities. New fair value gap right here. Price trades in, price trades lower until another fair value gap is created. Price trades in, trades away, and then we're on to bullish fair value gaps, as we explained in the last video. So I've got much more detailed videos on trading candle ranges, but what I'm hoping to just show you is how fair value gaps are created in price legs and how you can think about using them in combination with higher time frame candles to actually take trades. We're now going to look at a very similar example using USD Canadian dollar, and just use the exact same logic here just to show you how this plays out time and time again. And for me, I'm always trading swing positions, so a lot of the time I'm taking positions based on monthly, 2 weekly and weekly candles with 12-hour execution or 6-hour execution. However, price is fractal. So check out my multi-time frame analysis video because you can apply this to other time frames just as easily. So what did we talk about before? Candles being liquidated and the opposing end of their range being targeted by price. So in this specific candle, this 2-week candle you see right here, we see that price trades bullish, and within this we have, within these price legs, we have fair value gaps. So one right there, and you can see this candle 1, candle 2, imbalance, price trades in, trades away. And then what happens? We get another bullish fair value gap, price trades in, trades away. Price then comes into the next bullish fair value gap in this specific price leg, and then starts to consolidate. So we get a bearish fair value gap right here. Price, even though it looks bullish, actually respects that bearish fair value gap. Price has a way of appearing to do the opposite of what it intends to do to actually scare you out of the market. But what are we doing at this point? Again, we are liquidating the high of this candle here. So as soon as we get order flow in, whereby we have bullish fair value gaps, order flow out, bearish fair value gaps, you can look to place trades to target these types of levels, the highs and lows of accumulation candles. And what ends up happening is this fair value gap does get respected, and then a new fair value gap, bearish, has been created. So if you were to take this as your entry and cover the high, and then simply target the base of the accumulation candle, you've got nearly a 3-hour swing trade. And once you've actually played, as soon as this happens, you have candle 1, candle 2, you're coming from a bearish fair value gap, you have a liquidation of a high, you have a clear target, then really, especially if you're placing trades on the 12-hour time frame, you don't have to do a lot. You just have to wait for price to retrace, you get tagged into your order, and then you wait. And then you see no fair value gaps are created here, it's just literally consolidation. And then price just aggressively moves to liquidate the level that you're targeting. And that is where you need to get out of the trade, because obviously at that point, we can see what actually ends up happening is new bearish fair value gap is created. And then in this particular instance, and this is something we will talk more about, traded in, trades away, massive disrespect. And at that point, this is where you would then combine fair value gaps with other potential points of liquidity. So this might be an order block that you want to take an entry from, or if we take a look, a new bullish fair value gap is created. And what might this be indicating? It might be indicating, which actually happens, that we're now liquidating the base of this candle to continue higher. And this is where you could maybe look at the monthly to actually get a better steer of that. But the story just continues on and on and on. All higher time frame candles get liquidated. Fair value gaps tell the story in what's happening at these key highs and lows. So when you're coming into an old high, fair value gap disrespected, new bearish fair value gaps getting created, start to think about what is price trying to do. So if it's trying to liquidate this high, and actually we get a close here, then where is price gravitating towards? Probably this area here. Okay, let's look at some common mistakes when trading fair value gaps. So never trade fair value gaps in isolation. Don't just see fair value gaps getting created on your trading time frame, whatever time frame that is, and assume this is a good opportunity to go long or short. Trading fair value gaps always has to be done in the context of higher time frame bias and around key points of liquidity or towards higher time frame targets. So trade them in context of those higher time frame ideas. Don't just take a fair value gap being created as something that you need to trade. That, you know, they are not created equally. Also, always wait for candle 3 to close. So a lot of the time, candle 3 can be expanding. It looks forever, you know, like a fair value gap is going to be created. You feel confident that it is. It's nearing the close of that candle. You place your trade, and then price just reverses. The fair value gap does not get created. And you just get stopped out, and your trade idea just never materializes. So that's another big common mistake. And then finally, always be conscious of your higher time frame and what's happening with higher time frame fair value gaps, because if you ignore the fact that fair value gaps are being created on all time frames, then you're going to run into trouble, because you might have in my case, 12-hour fair value gap that gets created, but it's sitting above maybe a daily or 2 daily fair value gap. And so more liquidity needs to be targeted before the move actually goes on to occur. We're just going to finish with some bonus content on fair value gaps. We'll talk a lot more about fair value gaps, when to trade them, when not to trade them, and what they mean to be disrespected. But this is just to give you like some early view on this particular topic, disrespected fair value gaps. And what I mean by that is when a fair value gap is created, it gets disrespected, and then price reverses. The disrespect of the fair value gap can often be the first sign that price is actually going to reverse. And I'm just going to show you this to make 2 points. One, that fair value gaps get created on every single time frame. And two, you can use higher time frames and the respect and disrespect of fair value gaps to frame trade ideas. So this is Bitcoin USD, and what we can see on the weekly time frame is that we are currently price is somewhat consolidating, but respecting bearish price action, bearish fair value gaps at this particular stage of price. So this was back in late stage 2024. So we have this bearish price action in the market, bearish weekly fair value gaps being respected. And so at this point, we're almost expecting price to continue lower. And that's essentially what the market is shaping up to do. And you can see, if I just take this away, that once we get this bearish price action from this fair value gap, we're creating order blocks as well. So this is a weekly order block. But what happens is that, and this right here could be the early sign of it, but the creation of new bullish fair value gaps confirms price actually trades into the fair value gap and closes. And then when it actually does continue lower, it never trades below the old low in the market. And what ends up happening is that price continues bullish, so demand steps in, and a new fair value gap gets created with an order block as well. So this would be a weekly order block at this level. And so you can then, I mean, if you wanted to just take a trade on the weekly time frame, it would be a very good trade. But at this point here, you can dive onto your lower time frames to then look for signs that we're going to go higher and actually get a much better entry. But these higher time frames and the respect and disrespect of these fair value gaps give you a very, very strong clue as to what's happening in the market. Now, of course, you can also bake in higher time frames here as well, whereby you might want to look at the 3-month chart, because we're looking at the weekly, and actually that tells the same story that we saw earlier. We're liquidating a 3-month candle. We haven't taken the high of this candle. This was a bullish candle. We're in a downtrend. We get new fair value gaps starting to be created. There's the first. There's the second. This was a very strong sign that Bitcoin was going to start its next bullish expansion. And this story is told through fair value gaps and by combining higher time frames. So this has been a bit of a whistle-stop tour of fair value gaps, just to start to get you to grips with what fair value gaps are, how to mark them on your charts, how to start thinking about incorporating fair value gaps into your trading. Fair value gaps make up 1 point of internal range liquidity in a price leg. You've got order blocks, breaker blocks, swing points. They need to be used in conjunction with higher time frame trade ideas. So there's a lot to unpack, both with fair value gaps, but also in addition to fair value gaps. So keep checking out the videos that I'm creating. There's going to be a hell of a lot more, not only on fair value gaps and examples of when to and when not to trade fair value gaps, but also how they work alongside other aspects of trading. See you on the next one.